Today, let's look at the tax impacts on asset allocation. The tax consequence of a portfolio depends on the answer to two questions. The first question is, what kind of investment asset are we including in the portfolio? If we are buying bonds, then we know that the interest income from bonds are included in the investor's income and are taxed at a higher rate than dividends or capital gains. In contrast to bonds, gains from equities are taxed at a lower rate, but this kind of investment carries higher risk than investment-grade bonds. The second question to ask is, what kind of investment account are we using to construct the portfolio? If we choose an account type that allows investor to defer tax until the withdrawal, such as an RRSP account, then we do not need so much to worry about the immediate tax impacts. Therefore, we would usually build taxable accounts using equities because they are tax-advantaged assets, while bonds are usually included in tax-exempt accounts in order to minimize tax payable. While taxes reduce the average return of a portfolio, they also help reduce the risk or the standard deviation of the returns. This is because as taxes reduce the extreme values, whether it is a gain or a loss. Another question we may have is, since equities are taxed more favorably than bonds, should all taxable accounts include only equities? Not really. One advantage of investment-grade bonds is that they offer risk diversification to equity portfolios because investment-grade bonds are not correlated with equities. In contrast, high-yield bonds or junk bonds offer high returns in exchange for high risk, so they are not useful in diversifying risk with equities. One advantage of taxable portfolio over tax-exempt portfolio is that it has a broader rebalancing range. Remember that rebalancing range is the threshold beyond which we need to adjust the portfolio composition. With taxable portfolio, the return risk is lower because extreme returns are being tampered by tax. So, we can allow ourselves with broader rebalancing range. This means that we will need to buy or sell portfolio assets less frequently, and thus less taxes on realized gains will need to be paid. Hope you enjoyed this video. Please let me know if you have any questions. Happy studies, and see you next time.